did the 2018 DEB cash budget. It seems on first reading to be very straightforward. It's always a good idea to have a quick speed read through and see if there's anything extra thrown in that we haven't seen before that might throw you off. But there's nothing in this that we haven't seen before. So we start off. We lay it out. It's from March to August. They're my 6 months, so I put them in, and I'm going to start off with my receipts. And as usual, my receipts are cash sales. So we've got cash customers. 20% of sales will be for immediate cash, and a cash discount of 5% will be allowed. So we're getting 5% off the 20%. So 5% of 20% is 1%. So in reality, cash sales is 19%. So I would just work that out to be 95%. So I've got 95% of 20. You get 19%. Okay, so that's my way of doing it. You could work out 20% and then find 95% of your answer on your calculator. It's the same thing. So I'm going to do that straight away. So I've got my cash sales. They're 430. So 19% of that. So obviously they're cash sales, so they're in the same month as 81.7. Then 90% of 440. So 19 by 440. Is 83.6, then a 570 is 1083, then 19% of 590 is 112,100. For July, it's 19% of 625 is 118,750. And then 19% of August 630 is 119,700. That's my cash sales. I can move on to my credit customers then. So credit sales. So we'll have a read of it. Credit sales, 80% will be from credit customers, and these debtors will pay their bills 50% of the month after sale. So 50% of 80% is 40%. Now sometimes there's a cash discount at play there, or a discount given for that, but there's not in this question. So it's just 40%, and the remainder in the second month after sale. So we'll have credit sales 2 months. That'll also be 40%, so we're going to have the same number. So 40% of 430 from March will be collected in April. So we'll just find 40%. So it's of the 430, and that's 172. Sorry, it is 172. Then 40% of 440 is 176. We move on to the next one. So 40% of 570 from May will be collected in June. That's 228. June will be collected in July. So 590, 40% of that is 236. And then July's 625 is 250,000. Now August 630 is collected in September. We're only doing the cash budget as far as August, so we don't have to worry about that. So 0 there. We can go 0 here, 0 here, and then just bring the numbers down because they're the same number. So it's still, we're just 172 from May is going to be the same, or April is going to be the same in May, and so on. So they have to be the same number. Okay, so just be careful with those. Obviously, you're never going to know if you have them right or wrong. So we'll just add them together. And now obviously I have the benefit of doing these on a laptop, which makes them quite easy. But anyway, there we go. That's our receipts. So then our payments. We're going to follow the same sort of process, but just continue reading down. It says the cash payments is expected to be as follows. The purchases are all on credit, so credit supplies, The purchases will be paid for 50% in the month after purchase. So credit purchases 1 month, and it's going to be 50%. But you got a 2% cash discount. So 2% of 50% is 1%. So you're paying 49%. The remaining purchases will be paid for in the second month. So the remaining 50%. And there's no cash discount, so that's 50%. So we look at our purchases. 180 in March is paid 49%, which is 88,200, and then 50%, which will be 90,000, is being paid in May. The 210 from April is going to be paid in May and June, so 49%. The 210 in May, and June 50% is 105,000. Then we have the 250 from May. It's going to be paid in June and July, so 49% in June, and 125 in July, and then July is 330. 49% of that, and 165, and then July's 370 is 181,300. So now that's our purchases dealt with. So that should be straightforward enough. Again, you don't have to go beyond August. So we'll just go on then. Expenses are expected to be wages, 50,000 a month. So wages just go in, 50,000 a month, payable as incurred. So that means it's payable straight away. It's just 50,000 every month. Variable overhead, tenner per unit, payable as incurred. Now it doesn't tell us how many units we have, but we can work out how many units we have. The expected selling price is 100 per unit. So if we collect 430,000 from sales in March, well then 430,000 divided by 100 will give us the number of units. So that's 43,000. So it's going to be divided by 100 and multiplied by 10. Which of course is just divided by 10. So 430,000 divided by 100 multiplied by 10 is going to be 43,000. 440 divided by 100 multiplied by 10 is 44, and so on. 570 is going to be 57, 62,500 for July, and 60. Sorry, this one there. June is going to be 59,000. July 62,500. And August is 63,000. Okay, so it's divided by 100 multiplied by 10. Now the first sort of, I wouldn't say it's tricky, but slightly different. It says fixed overheads including depreciation is 70,000 a month, payable as incurred. Now depreciation is a non-cash expense, so it's not included in a cash budget. So we have to take it out. Fixed overhead, and we take out the depreciation. So I need to work out what that depreciation is now. So just going to come down here for a little bit. The depreciation, and it's going to be on the asset that we buy. So if we go down and look at the capital cost, that's the asset that we buy. So it says equipment will be purchased in March costing 48,000 and will have a useful life of 5 years. So that means you write it off over 5 years. So the depreciation is going to be 48,000 divided by 5. Which is 9,600. Now that's per year. We're in a cash budget. We need to work out what that is a month. 9,600 divided by 12 will give us that answer, which is 800. You could have also gone 48,000 divided by 60. So there's 60 months in 5 years, and that will give you 800. So we're taking out 800 out of the fixed overhead. So instead of being 70,000, it's 69,200 each month. Okay, so that's that one done. We can move on then. So capital costs. Equipment will be purchased in March, so we're just going to put that equipment in March. 48,000. Don't mind what its depreciation is. To finance this, you're getting a loan of 40,000. Now, when we come to it, the loan will go in the net cash. So it'll be net cash plus loan plus opening cash. So just remember to underline that or do something with that to remind us to come back to it later. And it's going to be 6% per annum. The capital sum will be repaid in 20 monthly installments. So that's the loan repayment. So it's probably starting in the first, it normally starts in the second month. So it starts in the 1st of April. So the loan is 40,000. So 40,000 divided by 20, because it's 20 equal installments, is 2,000. So 2,000 each month. Now, then you have to pay interest on it. The interest for each month is paid on the last day of the month based on the amount of the loan outstanding on that date. So we got the loan on the in March sometime. We can assume it's on the 1st of March. So the loan interest is going to be as follows. So the loan is 40,000. The loan interest is 6% of 40,000. So it's 6% of 40,000, and we're going to divide whatever answer we get by 12, because we have to work out what it is per month. So it's 200. Okay, so the loan interest in March is 200. You can assume, as I said, that the equipment was bought on the 1st of March. Alright, now, the loan interest in April, if we read it, the interest for each month is to be paid on the last day of the month based on the amount outstanding on that date. So if you've paid back on the 1st of April, you've paid back 2,000. Well, then the loan interest for the second month is going to be 6% of 38,000 divided by 12. Which is 190. Now that means, and you can work this out, that the interest on the amount that you repay each month is a tenner. So if you look, 6% of 2,000 divided by 12 is going to be 10 euros. It's going to go down by 10 each month. So you don't have to keep working it out. It just goes from 200 to 190 to 180 to 170 to 160 to 150. So once there's a linear amount paid off each time, just work out the difference and take it away once, and then just continue to take it away. So that's our loan interest. So that's them all in. So what we're going to do is we're going to add up all of our expenses. We get 210,400 there, and we'll just add them the same each across. So our total payments are those. Now I hope they're right. Sorry, these don't seem. Those two numbers look a bit high for the numbers, so for July that should have been 260. So let me just change that. Hopefully you spotted that when I was doing it. And then that should have been 330. I've used the wrong number. So it's just something to be careful of. I will be terrible at these questions because everything balances all the time. Sorry, that's 330. And that's going to be 130 there. So I don't know if these are going to, well, we'll find out. I'll have to check the marking scheme at the end, but that should be my only mistake looking at it. So what we do then, we're going to go net cash, loan, opening cash, and closing cash. Now I'm going to put the loan in straight away. So remember I said that's one you need to be aware of. So the net cash is total receipts minus total payments. So 81.7 minus 210,400. You're always going to get a minus in the first one. So then we get 2010, 85,020, 108,230, 146,490 and 126,950. Okay, for our loan then, so we're going to put in the bank loan of 40,000. There's no opening cash. Now, there's nothing to say there can't be an opening cash other to say that it's a brand new business. So it says Nash is preparing to set up a new business. So he's got no cash to start off with. So it has to be 0. The closing cash then is net cash plus loan plus opening cash. So he goes from 128,700 to 88,700. So whatever he finishes March with, he's going to start April with. And then you'll still have a minus, so 2010 minus 88,700 is 86,690. So we'll bring that across. So he's getting closer to positive numbers now. So 1670. Then he's into positive numbers. 108,230 minus 1670 is 106,560. So we'll bring that up. And he's into serious positive numbers from here on in. 253050. And 382,700. So that's our cash budget done. That's part A finished from March to August. So hopefully I'm right with that. I'm just going to, I'll check the market scheme at the end just to make sure. Alright, so prepare a budget profit and loss account for the 6 months ending 30th of the 8th. So that's part B. So our profit and loss account for a cash budget is sales less cost of sales. Now, so now the cost of sales basically is going to be all of the, it's not like opening stock plus purchases but minus closing stock or anything like that. It's going to be all of your expenses, ignoring your depreciation and your discounts. So what's our sales? Right, our sales is this number here, 3285000. Okay, our cost of sales. So our purchases first. Now this is ignoring, don't mind when you pay for it, don't mind anything else. It's just what you buy and what you sell. So our purchase is 1600. Alright, then that's our first expense. Our second expense then is our wages. So wages is 6 months by 50,000, which is 300,000. Then you've got your variable overhead. So it's your total variable overhead. So it's your total sales. Now you can do this a couple of ways. You can just add up your variable overheads, 43 all the way over. Or you can say it's your total sales divided by 100 multiplied by 10. So 3285 divided by 100 multiplied by 10. It's 3285 divided by 10, basically. So 328,500. And your fixed overheads, excluding your depreciation, so we don't include our depreciation, is 69,200 multiplied by 6, which is 346,000. It's multiplied by 6, that didn't seem right, 415,200. So that's all of our expenses. We don't include our interest and we don't include our depreciations. They're always shown separately. So there are costs of sales. So we'll take them away to find our gross profit. Now, this isn't technically right in accounting terms, but it's what we do in cash budgets. So what do we do then? We're going to take away our two other expenses, which is our depreciation, and we're going to take away our discount allowed. So our depreciation we know is, we worked it out earlier, to to be 800 a month, and it is by 6 months. So 800 by 6 is 4,800, and then our discount allowed is the discount we're given on, the discount we're giving our customers who we sell to. So our discount allowed, if you remember, is 2% of 20% of 3285. So it's 2% of 20% of 3285, which is one. Don't trust that number. Just go again there. So 20% cash discount of it's 5%. Sorry, 5% of 20% of 3285. 32,850. Again, just shows you the value of reading the questions carefully. I have the marking scheme in front of me now, just to make sure. So we're going to take that away. And then from that, we're going to add on the discount we give, or we get, sorry, which is the discount received on purchases. Now, the discount we receive on purchases is 2% of 50% of the purchases. Now, it's not of the total purchases. We didn't get a discount on the 370,000 yet. That's going to take place next year. So we have to take out the 370,000 from August. So that is 2% of 50% of 1.6 million minus 370, which is 12,300. Now we have to add that on. That's a discount we receive, so that's a gain. Okay, and that gives us our net profit. And obviously from that you have to take away your interest. And your interest is just your interest added up. So 200 plus 190 plus 180 plus 170 plus 160 plus 150. So that's 6 by 200. 1200 minus 50 is 1100 minus, I'll just do it. 200 plus 190 plus 180 plus 170 plus 160 plus 150, 1050, which we're going to have to take away. And that gives you your profit and loss balance of 614,900, and that is correct. Okay, so just all of your expenses, bar your discounts, depreciation and interest. Your discount allowed is your discount on sales, so 5% of 20% of your total sales. Your discount received is your discount on purchases, so 2% of 50% of total purchases minus your August purchases. And then your interest, the easiest way is just add up your interest in your cash budget. Okay, so that's that done. Explain what's meant by a master budget. Right, so a master budget is a summary of all of the budgets and provides an overview of the company for a planned period. So it's a summary of all budgets. Right, so we'll just get that down. So what's it do? It provides an overview. That's what all budgets do. Of the operations of the company for a planned future period. So list the components of a master budget. So the components of a master budget are a budgeted manufacturing account, a budgeted profit and loss account, and a budgeted balance sheet. So it's your final accounts basically, and that's what makes up your master budget. What's an adverse variance? An adverse variance is where costs exceed what you expected them to be in a budget. So adverse means worse. So it's where actual costs exceed budgeted costs, or where actual sales are less than budgeted sales. State why adverse variances might arise in direct labour costs. Well, so why could your labour costs be higher? I don't know. I suppose there could be a mandated pay rise that you didn't know about. So from a national pay agreement. So that if there's something like that comes in that you don't know about, you could have more labour hours to produce the goods. So anything like that. Okay, that should get us full marks. Okay, so that's the that question done, the 2018 DEB Nash. So it should be straightforward enough. Yeah, they don't actually take too long.